According to this expert, crypto's final stage has begun. Henrik Zeberg says the next move will be explosive and we'll get one last big rally before everything crashes hard.
I think you're going to see Bitcoin also taking off quite soon. And of course, that is what I was expecting and waiting for. So that moment.
Henrik is the head macroeconomist at Swissblock, a global wealth manager specializing in digital assets. He's one of the few analysts who can trace the line from global liquidity and policy shifts straight into crypto's price action. And his calls have earned him a reputation for seeing what others miss. Right now, he's calling for an extreme blow-off top in equities and crypto, driven by surging liquidity, followed by a crash that will hit harder than most people expect.
We have the largest bubble right now. I don't think there's any question about that.
Henrik backs every claim with data, combining deep macro research and technical signals to show how the markets really move long before the headlines.
You cannot print wealth. You can print something that looks like wealth for a certain period, but the moment inflation comes back and yield starts to rise, people will realize that the values that they were sitting with are actually don't have the size that they thought it was.
In this interview, guys, Henrik reveals how the same liquidity fueling today's rally is already setting up for tomorrow's reset.
I definitely see that the market should be going much higher here, and I see that the crypto market can also explode here. I definitely see that. We haven't seen anything of the alt season just yet. What I expect to see.
He lays out what all this means for stocks, Bitcoin, altcoins, and what everyday investors need to know to prepare for this next phase of the cycle. So guys, lock in, because this conversation is your roadmap to navigate the final euphoric leg before the big reset hits. And if you guys haven't seen the first interview we had with Henrik about a month ago, make sure that you check that out as well, because that was completely eye-opening and different from what almost everyone else is saying. So really excited to get Henrik back on the show to carry on this discussion, because it's a unique perspective back with data. So guys, without further ado, let's bring out Henrik to the stage. Henrik, welcome back. It's great to have you. I have so many questions based on our last discussion and, everything that's happened on the geopolitical, the macro landscape. Last time you said that we're going to have a 2008 type of recession, and that probably starts, I think last time you said it was 60 days or so. And
how far away are we now from that?
Well, I think that our last interview was about a month ago. So I'm saying, maybe
another month.
30 to 45 days. Is that still the case?
I think we have clear. If you look to the market, at least we do see that kind of very spiky thing that I was expecting, that we should see the market kind of go straight up. And when you look to the stock market, at least, and I think you're going to see Bitcoin also taking off quite soon. And of course, that is what I was expecting and waiting for. So that moment. But if you look to the, I can't remember how long we were with the whole revision things on the non-farm payrolls and everything, and now we haven't gotten the latest non-farm payrolls. But as I see it, I don't think there's a lot of signs of strength in the economy at this point, and that's why I think we are on that track. It would be nice to have seen those non-farm payrolls, but then again, we're not seeing something that is telling us that it's going to be tomorrow or the day after. I do see that the bottom is starting to the bottom could be closing in on the dollar, and I know that's not a popular thing to say, because people think it's going to crash, but I actually think it's going to put in a bottom after this next decline we see. So we still got a month's worth of time at least before we see what could be a meaningful top in some of the key risk assets as I see it.
Yeah, I think it's quite interesting that I think the dollar is down 12% on the year or something like that. And then I see a lot of headlines when I'm just scrolling about, why gold and silver are skyrocketing, in fears of a recession, a looming recession, as kind of a flight to safety or hedge. I've also seen headlines from, I think it's like Deutsche Bank and somebody else that believes that, before 2030, all of the central banks will be holding gold and Bitcoin, as a standard. Which that would suggest that people are starting to view Bitcoin in the same class as gold. I'm not sure if we've gotten to that point before. We've always kind of compared Bitcoin to digital gold, but it's really played out before as kind of a speculative asset and not so much of a store of value. But with that being said, do you think that the logic applies that maybe Bitcoin now has more officially kind of sealed that role as a store of value similar to gold, and that now major institutions and central banks and governments are looking at it the same way? And if that is the case, then we would expect gold to continue to rally on fears of a recession, and maybe Bitcoin to do the same thing. What are your thoughts on that?
I think it's all about the king dollar, I have to say. I know that's, again, as I just said, I don't think that is what people think right now. But if you go back to January, everybody was so sure that the dollar would just keep rising at that point. And there were all good reasons why the dollar should keep going to, 115, 120 or something. And then we saw the reversal, which I actually expected back then. Now I think you're going to see a reversal in that. And actually what you've seen since the top in September of 22, down to today, which has been like an L, kind of like zigzag kind of thing. I think you're going to see that is a very, very big correctional pattern. And so I know people talking about that we have seen a very big crash in the dollar at this point. I don't see that. I think we have seen a correction. And if you look to the market, even though yes, things go up and things will come down again, but the problem will be the next phase here where you're going to see a very, very strong dollar. And if that plays out, then we'll have to see what kind of assets that will do well in such a strong dollar environment. Because if I get it right, you'll see by let's say late 26, you're going to see that the dollar has reached 117, 120. And I don't think there will be a lot of risk assets, crypto especially, and also not gold and silver, that is going to like that. It actually seems like it's right. I know, again, the environment right now is not what that is, speaks for that, but that was the same thing in January. It didn't speak for that either there. Or in 22, when we had the top there as also in the dollar, people also thought it was about to just go straight up at that point. So we always know that the sentiment will be in the other camp of where the development sometimes is. So I think we could see a very big bottom in dollar. And when that starts to play out, that's what I've said all along. The moment we see that, then I think the real heroes will stand up.
So when we talk about the strength of the dollar and it going down, in this little short-term correction, when people weight the strength of the dollar, what are they comparing it against? So your dollar is down 12% to what?
So you're saying what it will be? So the dollar down today, they'll say it's down. Yeah, you can say it's down. It could be on the Dixie. It can be against so many things. It can also probably be against I don't know, Bitcoin also, obviously. But I think the problem is that when they say it's down, it's probably on the Dixie that they measure it. So they say it's gone from I don't know how high we were, 109 or something like that, and when you're down to 96 now. And I think that's the measurement that they take.
So what is a Dixie? So usually when you talk about like a price of an asset or a commodity, it's paired with another something, right? So it's Bitcoin,
correct.
USD or something like that. So the Dixie measures Bitcoin or the dollar versus what?
So the Dixie's measures is this. The Dixie is measured by, it's a basket of different currencies, and then you'll measure it. So the euro is 57.6%, and you have the pound sterling and so on. You have the Japanese yen and so on. So it's a basket of different currencies. So when the Dixie moves up and down, it depends on the strength of the various currencies that are in this basket, and that's how it works. So it's actually the Dixie is not the dollar itself. It's actually the dollar versus different currencies.
Okay, so yeah, that's what I thought. So, what I find interesting about this is that, so the dollar strength is usually determined by kind of how much inflation we're seeing in the dollar, how much its purchasing power is compared to other things. But when we also look at the other currencies around the world, certainly the Japanese yen, which their economy is really not doing well right now, so they have to print their way out of it. But it seems like it's not just Japan or the United States that are looking at printing a bunch of money. It seems like a global kind of crisis right now. And so when you look at probably what's going to happen with these really kind of weak economies where they're struggling, they're also going to be inflating their local currency, printing more to get themselves out of problems. So that's probably when we'll start to see, the dollar maybe just slightly less on that inflationary pressure, even though
But
we're also in a place where we have to print like crazy too.
yeah, but there's still the situation is still that you have the dollar so entangled in everything. So
Mm-hmm.
67% of all debt in the world is still denominated in the dollar, which means that we are also a certain degree short the dollar if you have some kind of debt in the world, which means that if the dollar starts to strengthen, which means it strengthens against the various currencies, well, then you will have a situation where the debt in the world will start to become more expensive to simply maintain. And that is
Mm-hmm.
the problem for the world. So when the dollar strengthens, that's when the rest of us gets a stranglehold on, and we start to feel that okay, we need to pay our debt, and it's going to be more and more expensive, especially emerging markets. So nobody really likes a strong dollar. The problem is if it gets too weak, then you'll have too much of inflationary pressures on. We have seen somewhat of inflation pressures over the last couple of years here, and I think we'll get to a period now where that completely will change, and you're going to see that the strength of the dollar is going to actually bring those inflationary power forces out of the game, so to speak, and then it's going to be something completely different. So the strength of the dollar is everything here, and that's why I'm saying if we get a deflation, if we have the largest bubble right now, I don't think there's any question about that. You can look to the
Mm-hmm.
to the stock market. You can say market
Yeah.
capitalization in many various ways in terms of standard deviations above the long term exponential mean and so on, in all sorts of ways. And every time you've had a bubble like that, and these have been smaller, you have seen the floor kind of open up, and you'll see that there are a lot of money that's going to be lost when that happens, because it's going to happen. That is one of the things with bubbles. They
Sure.
burst.
Yeah.
They
Yeah.
burst. And when that happens, a lot of money will be lost, and a lot of people will have to do restructuring of the debt and whatever, what have we. And when you do that, when you see that, that's where the dollar will come in as the one thing. And again, even though the dollar may be a very dirty shirt out there, it's actually the cleanest shirt compared to even the euro. I mean, I live in the euro area. I can see the problems with the eurozone here. We have countries like, and I love Greece. It's not about Greece, but I love the Greek people. But their economy is not as strong as the German, for instance, or the Dutch or the Danish. And what you'll see is that there are productivity gains in per year in Denmark and elsewhere, which is higher than what we see in Greece. And if you have
Mm-hmm.
that on an ongoing basis, there is an inbuilt which you can call structural friction of that currency system, which is what we see in the euro, and that's why the euro is not a clean sheet compared to a clean shirt compared to the dollar, and the dollar again is denominated in so many things. So if we get a crisis, where would you want us, hide out? What is it that you want to run to? And I still see that will be the dollar these days. There, we don't have an alternative to it. So the
Right.
problem will be at that point, if it does like that, strengthens a lot, as I see. What happens then to risk assets that are really sensitive to a strong dollar?
Yeah, that makes sense. I have a little bit of a kind of a theory here, and it's a little bit, I don't know if it's tinfoil hat or not, but I mean, to me, it kind of makes sense. Um, so, it's really difficult for politicians to win elections if the economy is bad and people don't have money, right? They're just going to point fingers at whoever's in the administration and say it's your fault.
Right.
So, we have the midterms coming up in 2026, which is very important. So, in America, for the Republicans to remain in the power position, right? So, we also saw, there's also some other things too. We saw Jerome Powell's speech the other day, and and from what I've read, the Federal Reserve executive board, the chairs or whatever from that, are pretty divided right now on whether they're going to, I think it was like 9 voting one way and 10 voting the other way. But it certainly seems like they're less likely to be aggressive. It's all the polls still show that we're going to get a 25 basis point cut this month, but potentially not even too. And then we'll see again if we get another one in December or not. But even if we don't, we have the new Fed chair coming in, right, which is appointed by Trump, said that he believes that the fair interest rate should be at 0.5%. So whether we get continuous rate cuts this year or early next year, it's going to happen, and so that usually leads to loosening policy and going to be much more open to kind of prescribing whatever the Trump admin wants them to do. So my thought is that it would be in the best interest of the Republican Party to do everything in their power to make sure that the market stays strong into midterms, and then I think that most people agree that there's definitely going to be some sort of recession. It's like long overdue. Plus all the economic data that we're seeing, it's a bubble, and the fact that there's just not a lot of money in the hands of everyday people. Just
Exactly. Correct.
1%, but not the others. But what we have seen also was a hint from Trump that maybe they're going to do some sort of stimulus checks to all eligible taxpayers, which reminds me a lot about the COVID stimulus, which really sent the markets into hyperdrive.
Mm-hmm.
So my kind of thesis, and I want to get your thoughts on it, are we still continue to see a strong market, at least until the midterms. And then after that, then they have 2 more years still to make sure that the markets are decent at that point for the 2028 elections. So so with the hinting of a stimulus to retail, to the citizens, at least to give some short-term liquidity back to the markets, loosening monetary policy and interest rates coming into at least early next year, and then perpetually too from that point on, because we're going to get cuts for sure once the new Fed chair comes in, and then probably continue to do that over the course of the next 2 years, which seems to me that then probably the best strategy, if they can control it, would be keep the markets rallying strong, stimulate whatever you need to do to keep things going until the midterms. After midterms are done, let the market do its thing, get a crash, in that very short term in late 2026 or something like that. And then that gives you all the more reason to go ahead and print money and stimulate and stuff like that to get the markets back up again, like we've seen in the COVID. And 2008 wasn't even it wasn't a super long staying down at the bottom kind of correction. It was really pumped back after that. So then my thoughts are that you would see another big injection of stimulus and printing and everything like that to do what you need to do from like late 2026 back into 6 months at least before the 2028 election, so that they can continue to be favorable, looked at by the public. So I'm wondering if you think that like that's something that the Republicans and Trump have in their ability to kind of do something like that, and if you think that that's a kind of a logical argument of why they could do everything in their power to continue to hold up the markets and things like that until then. Just what are your thoughts on that?
So this builds on a premise that they are able to keep the markets up if the economy is collapsing. If you start to see like what we have right now, as you just also pointed out correctly, as I see it, that the consumer is not well. I mean, there was a survey here not so long ago that showed that 15.6% of the US population find it very hard to put food on the table and have serious difficulties in putting food on the table. See, this is the real world to me, as I see it. The real world is also that you had housing affordability is in the gutter. It's actually as bad as it's been back to the 80s. Crazy. You see, the housing is, and I don't live in the US, but I don't study this, but I know of people and I talk to people also on a daily basis that says, this is actually what it looks like. So I think there is this disconnect between what can happen in the financial world, where everything is about liquidity that comes in, and then everything will be fine. That is back to the whole thinking of if we can just get the stock market to go, then the rest of the world will not matter. See,
well, yeah, for sure. Yeah.
And I just don't buy into that. And I think the problem is right now that there is that they actually have, that's what my new book is actually also about, that what I call the bust of the everything bubble caused by the central bank hubris, is simply that we have thought that we can create wealth, or the central banks have done that for so many years by saying, we'll just sprinkle a little bit of liquidity, and every time we see some kind of cracks coming up, right? Because it's that's easy. See, if we went back to our granddads and said to him, why didn't you just in the 60s and the 70s, why didn't you just sprinkle money on it every time you had a problem, every time there was a crack? Why did you take those recessions? Why did you go through all that hardship? In the 2020s here, we figured it out. We just throw money at it. And the guy, he would, or your granddad or my granddad would probably look at us and say, "What, are you crazy? You're going to get inflation." And what will that happen? You're going to piss off the consumers because they're going to see inflation is going to go up. Guess what? That's where we're at. So if they start now, and you can actually very clearly see if you look at certain charts that there is a new inflationary regime. Mm-hmm. I don't think it's going to go straight up, but if you look to it in the long-term perspective, you are actually seeing a very clear spike up, and it's showing also momentum-wise that we are now in a new inflationary regime. Jeff Gondlach has been talking about that. I think he's right. I just don't think it's going to go straight up from here, because I think we are actually not going to see that they just can try to pump the market like that. But if they do, then they are going to see that inflation will spike back up again. And then they're going to see that the consumer is going to get even more trust. So the balance act that they have to try to walk right now, it's not, I don't envy Powell or the rest of the Fed chairs there, or the Fed members there, their positions these days, is that, you're damned if you do and damned if you don't. And the problem is, if they go out and they start to hike, or if they become too accommodative at this point here, you can see inflation flare right back up again. I don't think it's so much a problem right now. But if you talk about putting fiscal stimulus in, like if you said Trump was going to do that, I haven't heard that. But if that's the case, then I can promise you, with what we have right now, inflation would go straight up again. And if there's one thing the consumer do not like, that's inflation. That's what we saw in 22, and that's what we struggle with right now. Is actually that's the aftermath of that. Because the thing with inflation is that when the price levels have risen 20%, they just don't go down again. And that's what the people that, ordinary people in the US and here in Denmark and elsewhere are sitting, the problem of, 4 years ago, it wasn't this expensive, and my wage hasn't covered this, which is why affordability of homes is so bad, because also rates are so high. So I think we're talking about something that would be nice if they could, and I would support it. I just don't think it would be realistic in the real world. And the problem will be, actually, I also think that if there had ever been any president in the world, in the history of the US, or any Fed chairman who would say, you know what, let's have that, recession, and just, if they could avoid it, they probably would have kicked the can, or they would do that. There are just, unfortunately, times where they cannot kick it any longer, because it's the consumer that is taking over. One of those years that we had a recession also beginning was 2008. And you can say also the Republicans back then also had all the reasons why they should have kept things going, because, and that was when Obama got in at that time, and McCain wanted to get elected, right? And you saw that did not happen back then, because the recession was still unfolding actually in the election year. So this about that we're trying to explain it with election years and say, oh, if it's election year or it's midterms, then it cannot happen, because we'll just sprinkle money on it and then everything will be fine. I just don't buy into that premise. And I think the problem will be that we'll see this time around that now it's getting serious. The problem is that we're starting to see the unfolding of this, that the economy is not as strong. Powell says this himself now. He finally realized it. The economy is not as strong as I said 9 months ago, because the consumer is not strong. And the consumer hasn't been feeling well for such a long time. So I think I would love to see that happening, because I don't like a crisis either. But I just unfortunately think that that's not, they don't have these omnipotent powers that they would like to have.
Yeah. I mean, just because you said you haven't heard of it so far, but just for your context is they're saying that they would do this stimulus from tariff revenue. So that one particularly wouldn't necessarily create more inflation, but I think to be able to hold up the economy temporarily until the midterms or something, that would require much more than just this one-time injection of capital of $1,500 to $2,000 per tax-paying citizen. So
and if it creates inflation, you will be eaten up very soon after, right? So
exactly, yeah, you'd have to. Yeah, exactly. I was just thinking that it does appear though that usually when a politician is campaigning and that they are not going to usually point to the average everyday citizen and how their well-being is. They're going to point to the stock market and say, look at all the rich people just got more rich while you guys are making less. To one regard, your average day, everyday American is going to say, I'm not making as much money, and all these prices are going up, and so therefore I'm hurting.
Mhm.
But I don't know. I'm just thinking maybe the propaganda machine because all of the rich kind of influencers, the all in podcast guys, and the Larry Finks and anyone else, Paul, who's doing well, they're gonna say like they're gonna be super happy because like their wealth is going up.
Mhm.
But but yeah, okay, that's a good point on that. So
And the problem is they can't just cover it up. If that's also the point here, if they want to cover it up, the problem is you can cover it up for as long as people don't get laid off. But right now, if you look at the utilization of capacity in businesses in the US right now, as I see it, it's down to 77%. That means that there is 23% free capacity. Normally, when we get down to 80, they start to slash people. This time around, it's been waiting a little longer because they had some difficulties in finding people some years back. But the problem is this time around, if we don't see, if we start to see the businesses starting to slash people, and we actually did not see in the large businesses, we did see the profit was kind of nice. But if you look outside of that, you'll actually see that the profit levels are not that great at this point. So if businesses and the real business in the US, just like here in Denmark, is not the big fancy ones. The real businesses are the small businesses with 5 to 20 people, working some kind of product that is just necessary for the community or something like that. These are the businesses of the U.S. and of most countries in the world. And if they have a bit hard time, so we don't need to look to Meta or Apple or all these. I mean, they are not a reflection of what
no,
goes on in the real world, and that's why I'm saying if the small medium sized businesses are going to start laying off people, which I think they could be getting closer to here with what I see in terms of utilization and so on and of capacity, then it's mighty fine that Google and else is doing fantastic. But they will also only do fantastic for as long as there will be small businesses actually wanting to advertise on their platforms. Because the moment they
Mhm.
start to pull back out, then the big numbers are not coming into these players as well. So it's down to looking at the Mrs. Johnson, as I always say it in the US, and looking at her and see, will she go out? If she gets some money in her hand, what will she do? And if they start to put stimulus onto it now, what then happens with inflation? So I would hope we could see this. I honestly, Kyle, I mean, I'm not a favor of it. We know that every time there's the unemployment rate goes up, there are people dying, there are people having a very hard time, and it's not something I like, absolutely not. And I think it would be much better if we do not have this. Unfortunately, I think these 17 years of central bank easing, where we just that's like what is the Argentinian chef there does, like with that, with the salt and the spicing. I
Yeah.
we can't do that. We can't keep doing that, and it will actually come out now, and it starts to come out of this inflation. And when that comes out, the hands of the Fed is pretty much tied, and that's why you've seen they've been so reluctant on actually getting into that easing path already, as I see it.
Yeah. And I think the interesting thing too about the stock market right now is that um, the Magnificent Seven make up the majority of the weight of that
Yeah,
500 index, and what you're seeing in that Mag Seven and some of the bigger private ones like OpenAI, but they're still tied to Microsoft, right, by
yeah, yeah.
49% or whatever. Is you're just seeing all the big guys invest in each other's companies, and Nvidia invests 20 billion into OpenAI, and then then they
Yeah,
buy Intel, and then
yeah.
Microsoft, and so all these guys are just I think
Pumping each
just
other. So
pumping each other. Exactly. Yeah.
yeah.
Uh,
That's
yeah. So
also why you see this discrepancy between the real world, as I see it, and then the world of the financial institutions, and where liquidity is everything. If you can just get some liquidity, free liquidity, that will help us to buy some more of our own stocks, so we can pump the stock price or whatever. But that does not help Mrs. Johnson. And I just have to say, 70% of the US GDP growth comes from consumption from people like Mrs. Johnson, and it's not the top, or as you said, the top 1 or 5 or 10% that sets the direction of the U.S. economy or any other economies. That is actually unfortunate. That is the real people of the country, and which are ordinary people earning a paycheck and having to make a thing ends meet. And as I see it, that is where the big uh, schism, or the big blind spot for at least also Powell. He was asked, 5 6 months ago on the from a journalist that after an FOMC, when what about the consumers? What is it that they don't see? You say we have such a great economy, and I can just remember I was just perplexed by his but that's because something terror, something blah blah blah. And he was like, wow, you just took and brushed off, one of the cleanest argument of most precise arguments on why you are not actually understanding what is going on. And
Right.
now here 5 6 months later, we're actually seeing exactly that's playing out, and the economy is not so strong as he thought. So I don't know. I don't have a lot of trust in them, I have to say.
Totally. I want to I want to shift gears into kind of your strategy leading up into what you believe will be this pretty significant recession. Um, so I'll get into that question in a second. But I heard you say that you just printed a book, and then I know that also recently you did a TED Talk, which was really well received.
Mm-hmm.
Tell us about the book, and then also we're going to link down below both where people can check out your book and also your TED Talk. But I'm curious because I don't remember you telling us about the book.
No, thank you for letting me. So the book is really about what we talk about here. The I call it the bust of the everything bubble caused by central bank hubris. So
Mm.
what I see is that you've had a almost 2 decades of central banks acting like demigods, thinking that they can micromanage the business cycle, thinking that if they want they have 2.7 inflation rate, they want it down to 2.1, and they think they can actually micromanage that kind of on to that degree without actually being able to. And just to look at their track record, I mean, that's the one thing we can go back and look at. They completely missed that inflation would spike to 9.1%.
Yeah.
They completely missed that. They completely missed also, that it wouldn't be, that would be transitory. They talked about that for some time also until they figured out it was not. They missed the financial crisis. They were in February of 2008 and they missed the financial crisis, and so on. We can just take the list and it just goes on and on how bad they have actually been in acting and reacting to the to any kind of slowdowns. So we now have trusted them with some of the most powerful tools in the world, and they have just ballooned the balance sheets because we kind of have an idea if we can just make if we can get the trickle down effect going, we can get actually, money printing in, we can get shares and people to start spending, then they will actually, spend enough and we can get a positive cycle going. The problem is now that going from 2008, the U.S. had had a debt of 60% to GDP. And now, after everything that's happened here, you see now the U.S. debt is now up to 120% to GDP, and you see also private people and organizations, and not just in the U.S. because you're not alone about this. You can just look to Europe; it's same thing. Everybody has debt. There is much more debt in the world. Guess what? If you actually go out and you lower interest rates, which is what the Fed has been doing by printing all this money and suppressing interest rate, what happens then? People think, oh, I can actually afford buying that house because now interest rate is 2% instead of 4%, which makes that I have much more, available. I'm richer. That we have seen, that we have harvested, that we have been pushing to the extremes here by lowering interest all the way down to zero, negative rates in Europe at some point. When we do that, there is a distortion going on, and people are thinking that there are things that may not be a good thing to invest in that they will actually invest in because there's no reason to go out and buy bonds there. So the problem is now we have had this extreme long period where we've been keep doing it, and you said it also earlier. Just put some money on it, and we'll keep it going. If it was that simple, then the Weimar Republic in Germany in the 1930s or 20s, actually 20s, would have actually had a bit better faith than what they ended up having, where we had hyperinflation. I don't think we're going to get hyperinflation for the US or the world right now, but the problem is you cannot print wealth. You can print something that looks like wealth for a certain period, but the moment inflation comes back and yield starts to rise, people will realize that the values that they were sitting with are actually not having, it's not they don't have the size that they thought it was.
Right.
And that's because valuation levels have been changed and now will be rechanged or come back to what we had some years ago. And when that happens, you're going to see that is the same as a bust in the market. Because right now, as we said before, the market is so extreme. And if
Yeah.
that starts to decline, people say, yeah, but where will the money rotate to? That's not like it works. If there might be 10 person that bought that stock somewhere, but if there's one person that's actually starting to sell it lower because that guy needs cash,
Yeah.
then the stock will actually drop. It doesn't matter what the other bought the two. It drops because the latest stock, the trade will be what it's worth. So that's the problem. And then the rest of the 9 other guys there, they all suddenly think, oh, it's not worth 100,000 any longer. I'm only, I'm down to 90. And then
Yeah.
another guy says, okay, then I need to sell. So the problem is there's not capital that is kind of locked in, and we all have this, artificial sum of money in the stock market. The
Yeah.
stock market is a balloon, and when it starts to come down, it can come down really fast. We saw it in April. Actually, there wasn't too much of a hassle there going on, and still it just dropped, and we saw some days really going fast. That's what happens when we have a large bubble going on. So if I'm right, we're not too distant or not too far away from this. I'm still saying 7,800 on the S&P, 8,000 even on the S&P is likely. We'll probably see it going more or less straight up, but coming out of that, I think there's going to be a change, and that's the bust that I unfortunately think we're going to see in at least in 26, but maybe already starting this year.
Yeah. So I'll give a quick story that was just a really interesting thing to observe when I was in my mid-20s, I guess it was, or low to mid-20s. I moved to Los Angeles, and my landlord, a guy named Jason, he had a really nice, when he acquired it, it was 4-bedroom, but he converted some of the bedrooms to divided them and made it into 6-bedroom, and he kind of decked the house out with all these games and made it really cool place to kind of co-live with some other young professionals. Anyway, the point is that he was really frugal. He made partner, junior partner at a law firm that he was working at, so making some pretty good money. And he was very frugal. He made good money, but he drove a really old Ford Expedition, whatever. He also didn't take the master bedroom in his house. He took the smallest bedroom. And then in 2008, when all the housing collapsed, he went to Vegas and he bought 4 or 5 houses within the same block, a really good location next to universities and stuff like that. Did the same model. He divided them up, put a bunch of games, and made it really appealing to rent out. And then that was it. And then he was able to kind of retire after that. He quit his job at the law firm, and he just lived off of the rental income from that point on forward. I tell that story because that wouldn't have been possible if he had tried to do that in 2007 or 6 or whatever. Timing is everything, and being prepared for these corrections can really make a huge difference in your life, right? I mean, people are buying Solana right now, are going to buy it at 250, 300, right? But what happens if it goes all the way back down to $80 or something like that in, let's say, 2026, right? Then, and then you can just go, we've seen these corrections have crazy price decreases and valuations on some of these really quality altcoins that we just know in the long run, they're going to go back up and surpass all-time highs. Same thing likely to probably happen with real estate. I don't know if it's going to be same as 2008, maybe not, but probably if everyone goes broke in big recession, no one can pay their mortgages, all of a sudden inventory skyrockets, prices come way down, people are forced to sell. So the point is that if you can be sitting on cash and then wait for the bottom of the recession to come in, wow, what a crazy opportunity you have. You're like the luckiest person in the world, because everyone else lost their money in the stock markets and their housing went down. And so no one has cash, but those who do have cash in those times can really clean up, right? And that's, we know historically, that's the best time to enter these markets is December 2022. If you had cash then, wow, you can come into crypto, you could have bought Solana and BNB and everything else.
You should actually have listened to me. I was actually telling people to get long of that. That was when I started to get long in the market. And actually, I was actually in let's just be honest, in July. It was 2 months too early, but it was in early. But yeah, I'm with you. That's it. We want to buy when when it's cheap,
Yeah.
and that's like also when we go and we want to buy a new coat. I mean, if it's a quality coat, you want to buy it when it's cheap. You don't want to buy it when it's expensive. But the problem is when it comes to stock market and to crypto, people have this tendency to think that if it's cheap, oh, then I shouldn't buy it. But
Yeah.
if it's been going up for 3 months or 6 months, then oh, now I should buy it because it's rising. It keeps rising. So
Yeah.
why is it that we have this kind of tendency when it comes to a stock, but we don't have it when I actually I work with a guy also that is very good at stock picking, and he's just sit there and he looks at it and look from a fundamental perspective and says, oh, this one looks great from a fundamental perspective, and then he says, well, what does it look like in technical terms? And we look at that, and he buys it, the code cheap, and then wait for it actually to become expensive, and not like the crowd. And the problem is often that you'll see that the crowd does the
Yeah.
opposite. They will often, flush in or rush in the moment when it's kind of getting a little frothy and people saying, okay, now it's been, and I've been in since 22. I mean, so I think I've been in for quite some time, and it's been a long bull market for me. But if you just started to get in, a few months ago, and you
Yeah.
started to see the bull market's going now, well, then I can understand you hoped it would last longer. So yeah,
Right.
I get you. It's
So
about buying when there's blood on the street, as somebody said.
yeah. So one of the things I would love to get your opinion on, I know you got to go soon, but
Mm.
it's this. It's like, so, people say like time in the market is better than trying to time the market. We just discussed that maybe that's not necessarily true, but the important part is, as now that you're saying this, every person on the planet saying this is like, we're looking at a really frothy Q4. We can't, it's really hard for us to look past that. But the point is that, like, how should folks know when to try to sell out into cash to be ready for that inevitable bubble popping? And another point is that most of the gains, when you look at like trough to peak, they come in that vertical parabolic place where if you're not in the market, then you miss the majority of the gains, basically. So
I'm with
that's
you.
really hard. Do you have any advice for that?
I'm with you on that. That's also why I'm still very long, even though people say, "But so Barrett, show me your shorts." I'm not short. I'm very very long, and you'll meet people that follow my positions also will know that. So I definitely see that the market should be going much higher here, and I see that the crypto market can also explode here. I definitely see that. We haven't seen anything of the alt season just yet. For what I expect to see, and we need the dollar actually getting closer to its top if we see, but that's for another day. So I'm with you. The vertical move to the ballistic kind of move that we see in the final end of it is what I call the blow off top. Then,
Yeah.
and when? Well, the problem is that there will be so much FOMO at the time when you start to see it, and nobody likes to believe something that just seems to go up. There's the second lot, the worst feeling in the market, the strongest emotion is that if you're starting to lose money in the market, that's a strong emotion you got there. But the second strongest is that if you jump out of something and you can see it continuing up,
Yeah.
that is also painful. That's FOMO, and so the thing is, people will find it difficult because there is so much sentiment, so much FOMO when things starts to go in the vertical and ballistic. And I think it's about saying, okay, certain level, I've had enough. I will not look back. I just close down the charts and then I focus on getting into the next thing. What I will be looking for in terms of when this should start to develop is to look to the dollar. And please do not fall into the sentiment where people say that the dollar is dying here. I mean, again, as I said, the sentiment, it's a dirty shirt out there, yes, but we're not having this whole de-dollarization, all that's going on. I don't see that, and I think when the dollar puts in the bottom, then start to be concerned about that, what that can bring, because the dollar wrecking ball, if that starts to swing, which it could, and if we get to the 117 or just when we get to about 100, 105, 100, remember that is not going to be a good thing for equities or for risk assets. So I would be looking for, if you start to see the dollar rising, then probably it's because that they're that kind of dynamics could be coming. So that is one sign to look for, at least.
Yeah. I just want to add to that. Usually, when you have this euphoria stage and everyone's feeling really, really good, that's not just retail FOMO. That creates like institutional FOMO, rich people FOMO. You'll start to see the ETF numbers soaring through the roof. This country's adopting this, and this is happening because everyone's like FOMOing in. And so at that point, because the macro news is just so bullish, it's really, really easy to point to everything and say, this time is different. Why would this end now? Look at everyone's getting in, this investor, this sovereign, ETFs are exploding. Like, it's up only, baby. Like, this is not stopping anytime soon. So I think that's why I really want to have a discussion about, what kind of else to look for. Maybe if you're open to it, Henrik, I'd like to have you back on, like we said last time, like every month, to see if there's anything that changes dramatically in your outlook. But if you're open to it too, in the next week or two, maybe we could have a short one where it continue just this last part of more indicators to look for in the short term. And I also kind of want to get into your thoughts on kind of which altcoins, when the rotation happens from, do we see Bitcoin dominance continue to increase, over October? And do we start to see altcoin season really, really pop off in November? If so, is it the majors, or they're like great, small caps, kind of get to see where you're at? So
yeah, sure. We definitely do that. No,
that'd be awesome.
I still hope for a very, very strong October. I think we will get that. So let's see. It's still a young October. So let's see if we don't get a big push here. So, but let's do that, Kyle. I find that great. Let's absolutely do that.
Henrik, thanks so much for coming on again. Really appreciate it, as always. Guys, go check out the links below for Henrik's TED Talk and the book as well. I'm definitely going to pick it up. Thanks again.
Thank you.